Well, good morning. This is John Cruz with University of Missouri Extension, and pleased to bring you the November Crop and Livestock Outlook. We're going to take you through a quick set of slides today to kind of give you the latest on what's happened since last month, um, and invite you to ask any questions as we get towards the end of the period. Please keep in mind your questions and bring those up and ask Wesley all the hard questions. At any rate, let me start with some special topics, some things that, of course, we've been keeping an eye on very closely. One is, not surprisingly, our harvesting progress is a little bit behind where we would be normally at this time of year, given how late the crop went in. For Missouri, right now our pace is such that there's really only been about 5 years or 13% of the years where we've kept history since 1981, where we've had a slower pace. So we do know that the harvesting pace has been very slow. This data does not include the information from last week because that won't get released until about 3 this afternoon, given the holiday yesterday. And you can also see that, but we're not the only ones behind. If you look at the rest of the United States in general, being close to just above 50% harvested on corn. So again, also a very slow pace nationally as well. One of the implications of this slow of a harvesting pace is that we may find that yields and quality may be affected. And so sometimes as a crop stands in the field, particularly with these cold and snowy conditions that we've been experiencing, we may see some further shrink in the overall yields and crop size. So it's something that we're kind of keeping an eye on. For the soybean side, for Missouri, we are also behind. You can see that there were only 11% of the years that were slower than this year. And in fact, until a couple of weeks ago, we were the new record in terms of harvesting progress. Slowness. So if we look at also then at the U.S. level, you can see that we're pretty close to around 75% harvested. So Missouri is running a little bit behind in terms of where the national level was. But again, it doesn't have this last week's progress in it. And I do know that there were a lot of farmers that talked about making good progress with harvesting soybeans this past week. Another slightly different issue that I wanted to raise with you was to kind of look at what's been happening with the value of U.S. Exports of agriculture and agricultural related products. And so one of the things that we're kind of looking at with this graph is over time, what has happened to the value of our agricultural exports? And you can see since about 2013-14. Now, this is a marketing year. It's a September-August marketing year. A lot of times you'll see this data presented on a calendar year basis, but I wanted to sync it with the crop year so we could kind of get a sense for what's happening. And it's really been flat to declining since 2013, the 2013 marketing year. And this is a concern. And you can see in particular going from 2017 to 2018, you can see that kind of that drop in the value. And so if we take a little closer look at that, where's that drop coming from? Well, as you might expect, it's coming from China. And you can see a pretty significant drop going from a little over 22 million or billion dollars down to $12 billion in China alone, while the rest of our trading partners our major trading partners seem to be kind of holding or slightly increasing, with the exception of a slight decline in Japan. So the trade war with China has had a significant impact on the value of our exports, and a lot of that difference right there is due to the decline or due to this ongoing trade war. And so that's something that we're going to have to keep an eye on. And it's one of the things that is really leading to some sluggishness in our demand outlook. If we look at the usual monitor for seeing how much impact the tariffs are having, I would say for this time of year, this is actually not unusual. I would say right now the prices have converged back together. It doesn't look like we're having a very big impact from tariffs, at least right at the moment. That gap would widen out to be a bit more like it was in early September, late August, if we were if the tariffs were really binding. So what does that mean? We've noticed, we've watched the soybean prices, we've watched other prices kind of jump around and be sensitive to the crop size, but also sort of having this downward trend. And what it means is in part that demand is fairly weak. And I know Marty's going to talk more about that as we get into corn, but it is a significant issue that we are watching closely, and we need some stronger demand to get us some momentum behind these prices. That's what we're really looking for. So with that, I'm going to pass the control over to Marty, and he's going to take you through the next corn outlook.
Okay, thanks, John. Okay, so corn outlook this month. So the USDA's revisions, they lowered the production and the yield a little bit. So we had a little lower production and yield. The yield cuts were essentially in line with what the trade was thinking. However, they didn't lower harvested acreage. So overall production didn't come down quite as much as the trade was anticipating on that, although the yield was revised down. This lower production was offset by lower use, though, particularly lower ethanol and lower export. So not a lot of impact on the ending stocks from the lower production estimate. And that theme, has really been running for the last several months. What we saw this month with USDA's revisions have kind of been an issue for the corn market for the last several months, in fact. John mentioned the harvest progress lagging, so we're running well behind on harvest, and this current weather is not helping a lot. Strong cash market versus steady to weak futures. So we really have kind of two markets here in a sense, with the cash market, at least in some areas, performing relatively well, whereas the futures market has been steady to weak, especially the last couple of weeks there in the futures market. And then South America, so far on track for a pretty large crop in South America, although it's pretty early to call it down there. So that's something that the market will be wrestling with for the next several months. We're just in the planning phase for the most part down in South America. As far as yield goes, the national yield revised down 1.4 bushels from October to 167 nationally. Here in Missouri, the yield was unchanged at 155. And again, the overall decline in the national yield was more or less in line with what the trade thinking. Production is now 13.661 billion bushels. They revised down 118 million from last month, and it was about 50-60 million, though higher than the trade estimates. So it wasn't really too far off compared to last year. The crop is down 759 million from 2018. So pretty significant reduction in the crop overall. We get to the balance sheet here. We've got some circles there. So there's the blue circle, 167 bushels per acre. Talked about that. It's down 1.4 from last month, and you can see pretty hefty decline from a year ago at 176.4. So the yields are off. I'm thinking back to the outlooks from later or earlier this summer. I mean, this crop is really kind of turned out to more or less kind of what we thought might happen in terms of the late planting and its impact on yield. Now, the final estimates will come out in January. USDA doesn't do a production estimate in December, so we'll get some revisions in January, and a trade I think leaning down a little bit, as John mentioned, with some of the harvest issues, especially up in the northern Midwest with cold and snow up there earlier. So probably maybe another bushel or two could come off of the yield. might ultimately see some further reduction in the harvested acreage, maybe something like 300,000 or 400,000, maybe as much as 500,000 could come off, let's say. So anyway, leaning a little lower on the production overall in the final analysis. But what's really been, I guess, not so much the crop side or the supply side that's has kind of held prices in check, because supplies have come down with the lower yields, but it's really the demand side. We've seen pretty consistent lower revisions, especially on exports. I'll talk a little bit more about that in a minute. If we kind of go down through the balance sheet here, feed and residual was revised down a little. That's probably mostly due just to lower production. Lower production tend to have lower residual use, so that number came down. Exports were down another 50 million. You can see 1.850. That compares to 2.065 a year ago. So we're looking at pretty significant revisions year over year on exports. Ending stocks down at 1.9 essentially billion bushels carryover, and the farm price actually edged up a little bit, edged up a nickel from last month. One thing I wanted to point out here, though, so looking our carryover this year at 1.9 billion, if you look over to that further column over there with the FAPRI estimates for 2021, that circle at the top, 91.9. So we're looking at expectations, at least for higher acreage next year. With higher acreage and a return to something closer to a normal yield or trend line type yield, you can see how the ending stocks numbers down there at the bottom, go from 1.9 up to 2.233 billion. The USDA, their long-term projection was out here a week or two ago, and their numbers look even a little more negative in terms of higher acreage and larger stocks build, with prices down closer to 340 season average price. So anyway, I just want to point this out. We'll talk about this in a minute, but with the higher acreage and return to normal yields, it looks like we'll be on track for a pretty big increase in stocks next year. Okay, there's the exports. Just wanted to point out that this is the export sales, export commitments report they put out each week, and you can see we're tracking near the low end of the last several years here at essentially about 500 million bushels of commitments on the books so far. Well below most of the recent years. I think last week's export sales were I think about 18 million bushels. We need to be running closer to 33 million bushels a week to reach the USDA forecast. So anyway, and that's one of the reasons why we saw USDA revise their export forecast down in this latest update. This is a slide put together just to point out, what I was talking about earlier in terms of the changes in the export, in the demand side in the forecast. So going back to, the May supply demand estimates for the 2019/20 marketing year. That's the first supply demand table we got from the WASDE. And so, over the course of those several months, we've seen the demand side revisions, and these numbers total up to 725 million bushels. I don't have everything on here, but in terms of ethanol exports, feed and residual, well over 700 million bushels of downward adjustments in the demand side. And as we've seen the production forecasts come down, but we've also offset a lot of that with lower use. So I guess in terms of my expectations, we've seen the demand side revisions come down a little sooner and a little faster than I expected. If it not for this, we would see stocks a lot tighter, and prices would be obviously quite a bit higher. And rather than this $3.50 to $4 range, we'd probably be looking at something on the nearby futures more like $4 to $4.50. This is a slide I got on the what we call the forward curve in the futures. So this is just showing the carrying charges or the structure of the futures market, from the December contract. This is, I think, as of the closes here, I believe it was yesterday. And showing the carry that we have in the market from December out through the July contract, a little bit of a dip into September, then carrying charges again out to December to March 2021. So I just want to point out here that there is a decent amount of carry in the futures market, which is something we could use to earn some of the storage returns on corn that you've got stored in the bin. Talk about the basis just for a minute. This is a map of the basis. You can see there for Missouri, sort of the western 2/3 of the state in blue with the basis. This is a deviation from the average. So that blue is the basis that's above average. So, a lot of that area with basis at, 20 to 30 cents per bushel higher than the 3-year average. So that's a pretty strong basis across much of the state. Over there to the east side, closer to the river, however, the basis is a little stronger, but not quite as aggressively as it is on the other part of the state. I think that's probably due to the fact that we have had the sluggish export book for corn, so not the need to bid up very aggressively on the basis to attract those bushels to the river market. Here we got just a couple of locations to kind of get a sense of that. So Kansas City, you can see there, the red line is the current marketing year, 2019. You can see how the basis is running a little about 20, 25 cents over. This is Kansas City market on the top. New Madrid there down in the south east part of the state, you can see the basis has been strengthening, but not up as much as it is relative to the 3-year average. So again, pretty strong basis opportunities here in the sort of the middle to western part of the state, and not quite so strong in the east. This is March 2010 futures. So last month we talked about how the market was tracking, kind of an analog year there to 2009-10 marketing year. So I put in the March 2010 futures once again to kind of see where we are relative to that. Well, we've weakened a little more than this one did back in the sort of mid to late fall. If we get some kind of a rebound, prices kind of held in a trading range essentially that year until you got out to the early part of January, and then we saw market move quite a bit lower fairly sharply, essentially following the January crop report that year. This is the December 2020 futures. We've been moving a little bit lower. The scale there kind of exaggerates it a little bit. Essentially, kind of running between the high 390s, let's say, up to about 410, 415, something like that, down toward the lower end of that range now. So I guess one of the things I wanted to talk a little bit about is the possibility of making some new crop sales. I don't think it's too soon to take a look at that. If the FAPRI numbers pan out, with that increase in acreage and higher yields, and we build stocks back to 2.2, 2.3 billion, this December futures contract is probably going to be trading down a lot closer to $3.50 than it is $4. So if we get some recovery in here back towards that, above $4, certainly between let's say 410, 415, I think that looks like it could be an opportunity at least to begin locking in some of your 2020 crop. Okay, just to summarize here, so how long will this basis strength last? I think that's kind of the number one thing here. If you got any short-term marketing, you have an opportunity to take advantage of this strong basis. I don't think that the strong basis is likely to last. Typically, if you have a strong base, it's driven, largely by strong demand, and that's really not the case this year. I think a lot of the basis strength is mainly just the fact that we put a lot of corn in the bin this year. And so we've seen the basis firm up, but that stored corn is going to eventually come out. And I think basis becomes particularly vulnerable to weakening as we move toward the end of the calendar year, and certainly by early part of 2020. So I think take advantage of that basis to make some sales of the old crop if you can. If you don't have the basis opportunity, you can take a look at maybe a hedge to arrive type contract or selling some of those deferred futures to earn that or lock in that carrying charge in the market as an opportunity. Then wait for the basis strength to come, later on through the winter into the spring. South America is going to be a big factor in the market, but not right now. So far, things are looking reasonably good, although it's just planning time down there. So we'll have to, kind of wait and see on that. And then as far as 2020 marketing, we talked about that. I think it's not too soon to consider, getting with some looking at some sales, getting some sales on the books for the new crop. So with that, John, I'm going to turn it back over to you.
So I'm going to go right to the S&U on the soybean side. And first of all, I just want to note there's been very few changes to soybeans in the November updates. Not really a lot of exciting things. They revised down crush a little bit from 2019. And really that just ended up in ending stocks. The price ranged or the price level didn't change. It stayed right at $9 a bushel. And you can see one of the things we're watching is what happens to area planted next year. 85.5 by historical standards is still a fairly weak soybean number. And that's probably because the price ratios really still favor corn. One of the things that we haven't seen that I think some were expecting was with some of the easing of the export tariffs and some of the recent discussions about a potential agreement that we would see more sales to China. And but really what we're finding is that the Brazilian crop is still fairly competitive with the U.S. crop. And so those sales haven't been quite as easy as we might have hoped. And just because China's buying doesn't, they've also got a pretty strong impact from African swine fever. And that may ultimately play a bigger role in terms of where their long run demand goes with both U.S. and Brazil and Argentina, for that matter, supplying soybeans to China longer term. Look at accumulated sales and exports to date in total. Right now, we are running pretty much just touched where we were last year at this time. Hopefully, we'll get some more positive movement, with sales to China, but we'll see how this goes. It's one of those things where it's hard to. This has been very difficult to predict exactly how quickly that will recover. But at least right now, we finally caught back up with where we were at this time last year, but still significantly below previous years. Looking at where we were this time versus last year at this time on exports to China, you can see that we are, in fact, quite a bit higher. At this time last year, we still had China canceling sales. So we are at least in a better position. What has happened is we've got a little bit weaker demand from some of the other countries who had bought more soybeans at this point. So if you look at that in total here, you can see that at least we've recovered from where we were last year a bit on China, but certainly nowhere near where we used to be. If you look at the 2017-18 number, up above 600 million bushels by this time of year. So still not even quite half of the normal pace for sales to China. You can see the EU is not quite as strong in terms of their imports this year. A little better crop on the rapeseed side there, so perhaps not quite as much meal demand. And you can also see Mexico not importing quite at the same pace as last year, but it's very early in the season yet, so there's still a lot of time there to make up some difference. From the competing country side, there wasn't a lot of change in the S&Us for Argentina and Brazil. Really, just some minor things. Not a lot to talk about there yet. We're keeping an eye, of course, on the crop size, but no changes for November. So I won't belabor that point. If you look at where we're headed, here's the nearby futures. You can see the January futures. We took a little dip here after the USDA report. The trade was expecting a slightly bigger downward revision in soybean production than what we got. They were also looking for a little more positive news out of the export side, and we just really haven't seen that show up. I would say a lot of that 30-cent decline that's happened over the last few weeks has been related to sort of the weakness in demand overall. And so we're going to have to keep an eye on that. One of the things that this is the November 2020 soybean futures. So this is looking at next year's crop. I know that we haven't even got this one harvested yet, but if we think out about next year, keeping an eye out for those pricing opportunities. And so one of the things I did with this graph was try to put in several months of history so that you could look back and say, well, when I was trying to think about marketing the 2019 crop, where were my opportunities and where are they looking at as we look forward for the 2020 crop? And I think we should be paying attention when we get above the 970 range in terms of maybe taking some pricing opportunities. Certainly, if you get above $10 a bushel, that's a pretty strong signal that you should price part of that 2020 crop. So, in summary, not much change since the November estimates. You can see that we didn't get, the trade was expecting a little bit lower crop. That may still happen because we still do have a lot of soybeans out there in the field. Really, the weakness in demand is kind of the underlying concern. And if you see the pricing, there may be some pricing opportunities somewhere in that 970 to $10 a bushel range. May be a good opportunity to price some of that 2020 crop. I'm not saying sell the whole thing, but I'm saying that it may be not a bad idea to price 10 or 20% of that crop at those prices. And so with that, I'm going to turn it over to David Reinbott, and he's going to take us through the technicals on that.
Okay, well, thank you. Thanks, John and Marty. You did a great job, and I really can't add a whole lot what you guys had to say. The thing I want to just point out, I think, was already shown this March 2020 futures chart, and what I always like to look at is moving averages and things like that. And you can see we hit that 200-day moving average and just sort of stopped. And two things I noticed, I didn't circle it, but if you look to the left a little bit back in probably August, we had a gap. We filled a gap. A lot of times gaps are sort of like magnets. They filled it, hit the 200-day moving average, and stopped. And again, the market really couldn't move ahead on any more news. Again, as Marty pointed out, the exports have been sort of weak on corn, so that's probably a lot of it. And the crop has been cut as much as they sort of expected. I think if you listen to social media, you think we'd have a zero crop out there sometimes, but I think you have to sort of put that to the side and sort of just sort of say what's happening. And I think something I to add to is I think sometimes USDA and NASS gets a bad rap, but I think they do a pretty good job overall. And when you look at what they do, next support's around $3.65, and that's probably maybe where we're going to head to the next time down. I also look to the left, back in June, July, where prices were just a few months ago, and again, a lot of times seasonally, usually sometimes in that March through July gives us some of our best marking opportunities, and we always need to take advantage of those things. Here's December, again, sort of the same thing. Look at it, we hit right that 200-day moving average, and what we did, we stopped. And now it looks like we're heading back down to maybe the September low. Here, it wouldn't surprise me, at 395. And again, I think it was sort of alluded to already, back last spring, early summer, we had some 420 plus corn on the board. And I like to look at the weeklies, just sort of give me a sort of a long-term view. And this is sort of what I think. I maybe John and Marty, again, maybe have some thoughts on this, but to me, if I look at corn, soybeans, and wheat, we're really in a big trading range now. Unless there's some major shift in the demand, it looks like to me corn trades between 350, looks like, and about 430 or so, 420. And anytime you get in the top of that range or hitting that over $4 corn on the December, farmer probably needs to start selling some of it. I think that's pretty well what it says. And then once we get past the usually summer problems, summer weather, good idea of the crops, the market gravitates down to the lower end of that trading range, and we sort of work it up again. And again, as sort of Marty, I think, pointed out, from the FAFRI number, we're probably looking at a 2 billion bushel ending stocks number, which means we're going to have some weather problems again in the United States, again next year a little bit, or South America. And so we'll have to sort of watch. I always look at what's weather going on, it has a big impact. Here's the same thing in March. I'll skip it due to time. You can take a look at that later. Here's the turns of soybeans. Here is the February 2020. And again, we sort of hit that high from back last summer, around 960. We've sort of backed off. We're finding support around that 200-day moving average. You look at sort of a retracement of 62% of this last move, about 905. So that'd be sort of my next target. And let me see. And I think 880, I believe, is be the next target. So we'll see what happens. But again, I sort of think like all these crops, we're sort of at a trading range. We hit the top, and now we're going to try to maybe test some of the lows. Maybe here's the November 2020, sort of the same thing where we've rallied up here in September, sort of went back to these highs of back summer. Now I think the next support will be that 200-day moving average around 950. If we break that, then maybe around 935 or something like that would probably be my next goal. Here's the weekly, and it's sort of the same thing, about $10, 1020, 1040 was sort of our top end. You notice the last couple of years, it's sort of stalled out. And I would say a lot of that has been what? The tariffs, growing ending stocks. And, the last tariff payments, what were they last year? About $1.40 or so. Well, if you add that $1.40 or so to that peak there, you're probably back up over that 1080 level or so. So that's sort of the way I sort of look at it. But again, I think we're in sort of a trading range. Maybe the upper eights is probably our bottom this November, and maybe right now until this tariff thing gets started straightened out, this trade thing, maybe 960, 980 is maybe all we're going to be getting out of it, or maybe 920. And I think, again, as Marty and John sort of said, hey, we're upper in these ranges, probably God needs to be selling some new crop corn and beans. There's the wheat, again, you can see wheat has started to back off. Usually October seasonally is not a bad time to make some sales. Again, we're testing that 200-day moving average. I know here in Southeast Missouri, our wheat acres keep getting less and less. Guys just grow less acres of wheat, grow more corn, beans, maybe shift over to cotton the last few years. If you look at a retracement, 62% is about $5. If you look at the weekly, again, about a 420 has been sort of using July, it's probably your low. About anything over 6, it definitely is a sell signal in July wheat, or anything we're probably 550, 560 also. Rice and cotton, okay. There's cotton. The basic thing I want to say about cotton, I don't know if anybody's on cotton here listening, is that acres of cotton has really fallen off. And I think it's a story to be told, is that once you get acres up and you get yields growing like we did in 2018, you're overproduced, and what happens? Prices start to tumble pretty quick. And this past year, we had either acres were pretty good acres, and again, we had a lot of crop planted, 91% harvested. Texas makes the cotton market. They grow over about half the cotton. Going for this coming year, you can see right now the FAFRI number says about 13 million, ending stocks about 6. John Robinson, I was reading his article from Texas A&M. He says that his number using sort of a corn cotton ratio, maybe around 11 to 12. So there may be some potential in cotton. We're going to show you in a minute if we maybe drop these acres down 1 million or 2, which means, of course, more corn and bean acres. There's cotton, and maybe that's what they're looking at right now. You see December 2020 cotton next year is a nice little rally, but I think as John made the comment, anything in the 70s should need to be sold. And there's a December cotton futures. Again, I sort of see the same thing. Anything in the upper 50s is probably your support. Anything in the 70s is probably resistance and probably needs to be sold, especially the mid 70s. Rice, basically, the good thing about rice, any stocks are starting to drop a little bit, but again, the United States, we only grow a very small percentage of all the world rice. I think we're about like 1% or something like that. I don't think it's that much. Um, our contribution is probably no, I think it's more like 6%. I'll take that back. Our the 1% may have 6% of the exports, but looks like to me rice is just sort of a trading range down. And I'm going to show you here. Anytime you get rice up in that upper 12 to 12.60, you probably need to be a selling opportunity, and that's where we're at right now. I'll throw this last one. I know on cattle. I don't follow the cattle market, even supply and demand, but I thought it's a good technical chart to look at. Cattle fell off pretty hard. I think part of it was I maybe had some problems with I believe packing feedlot or what a packing thing out in Kansas. But at the bottom of September, and they put in what we call a Morningstar buy signal. You had some divergence on the prices. Those are all sort of points that, hey, maybe from a technical standpoint, this thing's going to rally. And we had a nice little rally. And you see that in the markets. And I just want to show that as a picture, sort of look for that, is that sometimes you'll see these Morningstar signal. You'll see some of these technical signals before maybe the fundamentals kick in and say, hey, maybe the big commodity funds, the big funds who are buying say, hey, this market's maybe overdone it. And now we're going to see a little rally. I would say that probably cattle today is just sort of hanging in there right now. And you look at to the left, maybe we're starting to put a little temporary high. So if you're a cattle producer, maybe if you're feeding out cattle, maybe locking some of this in.
All right. I appreciate Dave showing that slide on the cattle, because that actually is going to lead right into what we're talking about a little bit. So I wanted to start off with this slide right here. This is the sum of the beef, pork, and chicken production in the U.S. And I think this just highlights the story that we've been telling for the last 5 years, essentially. If you look, for about 8 years there, we had produced within a range. I mean, beef and pork and chicken would all alternate. One might be up and one might be down, but we were alternating from about 84 billion pounds to 86 billion pounds within that very tight range. And then all of a sudden in 2014, we took off. And this chart to me says it all. I mean, we have increased supplies basically 2 billion plus pounds for the last 5, and forecasted to go for 6 into 2020 for 6 years in a row, producing 2 billion more pounds. And if you think back to Economics 101, supply and demand, if you increase supplies this much, price has to drop, right? Well, the good news is demand has kind of turned around for us, and things have went well. I remember back early in my career when the Atkins diet took off and kind of petered out, and we thought, man, this may be the end of the good thing of beef demand. But right now we're enjoying very good meat demand. But the question becomes, how much is too much for consumers? So if you take exports out of that, this is the domestic meat availability of the big three. And if you look, this year we have more meat for each one of us to eat than we have had essentially in the last 40 years. So we've got to keep, if we want prices not to tank, we've got to keep consumers eating and keep this strong demand going. If you look at, this is the slaughter steer prices. Slaughter steer prices, that dark blue line, 2019, had been basically tracking fairly well with last year until, as Dave mentioned, the Tyson plant shut us down, and we lost so much capacity there in slaughter capacity, and prices bottomed out to just over $100, $100 or $1 a pound. We have since, whenever that thing did turn, as in the technicals, as Dave showed, and box beef started improving, slaughter steer prices have climbed back, and we've basically gained that back. I believe this last week, choice box beef was up over $6 a hundred, which puts us right now $20 a hundred higher than we were even this time last year. So one of the rubs or the concerns for beef producers is, well, box beef prices are great, but why is the producer share of that not increasing as well? So if we look at calf prices, however, kind of tends to tell a little different story. So calf prices have been falling behind where they were last year, because of the higher potential price for corn. But then after the Tyson fire, they tanked and went down as well, but they have not recovered. And so the question becomes, if slaughter steer prices are improving, if box beef prices are improving, if the feeder calf futures are improving, why are the cash cattle prices not? Well, there's a lot of theories on this. One of the things I think that it did was we always have the fall glut of when we start bringing a lot of unweaned calves to market, and with the forage conditions, I think we delayed a lot of those that would have been marketed the last couple of months because prices were bad and we had extra forage, so people just kept them out there. And we are getting very, very heavy receipts right now in our cash markets. So I think the Tyson fire just kind of pushed us into the October, November low, 60 days ahead of schedule, essentially, and we haven't been able to climb out of it. Last week, we had the second highest receipts in our auction barns of the year, second behind only the first week of the year, which was after the markets have been shut down for 2 weeks over the holidays. So if you think about it, that are very, very heavy receipts that the cash markets are receiving. Now, a lot of people are talking about have we turned the cattle cycle? Have we started to liquidate the herd? And they're talking about all the cows that are going to slaughter. And no doubt we have slaughtered a lot of dairy cows. What about beef cows this year? Well, we have slaughtered more beef cattle than we have in previous years. But if you look at this, I wanted to show this slide to just show that we're really just kind of getting back to that long-term average. We're not slaughtering a higher percentage. This is a slaughter percentage as a percentage of the January 1 inventory. We're just kind of getting back to that long-term average. So it'll be interesting to see what happens in the last quarter of the year here. If for some reason cow slaughter does get higher than this, but right now it's not looking like it's too much excess. But what we are doing that is a very, very positive for us is this is the percent of heifers of the total on-feed numbers. And if you look, this year in 2019, we have actually surpassed the high that we even got back in the droughts of 2010, 11, and 12, that the percentage of heifers is very, very high in the slaughter mix. So that's a good thing because you can see exactly what happened there in 14 to 15 whenever we started saving heifers, how we turned around the cow herd so fast. Now, one of my concerns is, again, drought has not been an issue hardly anywhere in the United States this year, and prices are well below where they've been. The calf prices, that is, have been well below where they've been in the last year or so. So I'm afraid a lot of breeders are going to say, well, hey, I'm not going to sell that girl, that calf for heifer calf for $600. I'll just turn her into a cow. So if this number of heifer on feed starts dropping drastically, then it may change this next slide, which is how many more beef cows are we really going to have? It depends. It depends who you talk to. There's about an equal number of people that say January 1 of 2020 that we will actually be into the liquidation phase and be down on cow numbers. I tend to be one of those that think based on the numbers we're seeing, we're going to be flat. But at least we hope that we have finally topped out the number of cows and may start into the liquidation phase if we don't start saving back more heifers. Here we go. So barrel and gilt prices, hog prices. There again, John didn't mention ASF in the big issues in the beginning like we did last month, but ASF, African swine fever, is the big thing that is influencing the hog prices. We got a lot of excitement back in the spring and into the summer about how much pork we were going to get to send to China, and unfortunately, that just really has not quite materialized here into higher prices into the latter year. We are going to see that we're sending more shipments now, but the extreme optimism about what this is going to do to prices just hasn't quite really materialized yet. We have in the data started seeing upticks in weekly pork shipments to China, as well as the shipments to non-China. We had been actually tailing behind, but here recently we had a uptick that we're above previous years, Now, there is some question about this because this was actually mostly to Mexico and just a slight bit to Japan. And so there's some question about whether this data is actually maybe the way it was reported. Is it really that much of an uptick? But I do feel like as ASF is expanding to more of the Asian countries that we have a better trading arrangements with, like South Korea, I do think we're going to continue to ship more pork to some of those other countries. This is the November WASDE numbers, and if you look at this as compared to the October numbers, this production number, that top blue line, just keeps going up. It seems like every month whenever we look at this, we have a little bit more production. The good news is USDA is pretty optimistic on the exports. If you look at that, 2019, 17.4 billion pounds, and 2020, 18.6. That's a great increase in exports, but that's 1.2 more billion pounds of exports. But if you look up above in production, we've got 2.5 billion more pounds of production. So what does that mean? Well, that means we've got more of this for us to eat here in the United States. The availability, I showed that graphic earlier because some people like numbers and some people don't. But just look at that 2018. Each of us has 219.5 pounds to eat. 2019. Oh, that was 2018. 2019, 222.8, and 2020, 223.9. That's only another pound, but that is more pounds for us to eat than we've had to do in 40 years. And beef is actually, in the November number, is down just slightly, a tenth of a percent there for 2020, but pork and chicken well more than have increases that well more than do that. So if you look at the prices, USDA is saying 116 for fed steer prices next year and 57 for barrel and gilt. But look at where the barrel and gilt is in 2019. They think they're going to end up about 48. Going to 57 next year is a huge, huge increase. So they are really, really banking on the optimism of what ASF is doing in the Asian countries and how much pork we're going to be able to export to China and elsewhere. It's kind of the tale of two stories. The pork industry is really ramping up production for this. Let's hope that exports, and let's hope these trade markets do actually work out and we get all of that shipments to those countries, because if not, and we have to eat all of that pork here, I could tell the tale where next year could be one of the best years for pork producers, and I could tell the tale where next year could be one of the worst years for pork producers. I actually feel like USDA may be a little bit conservative on the fed steer side. There's a lot of optimism right now with demand. If demand can keep cranking the way it is, especially quality beef is doing extremely well, we may actually see higher beef prices in the next year if demand can keep going. The concern, of course, is will we have ever or overdue for a recession? So is something like that going to occur, and with wages and unemployment changes, we definitely need demand continue cranking. With that, I will turn it over to John.
Okay. So I do want to mention, first of all, before we go to questions, we do have a Zoom call scheduled for the 12th of December as well. I do have to resend out, I apologize for this, the connection information for that call, because we have rescheduled it. We were having a little trouble with the software, and of course had to upgrade, but I think so we have a new meeting number and such for that particular call. So I did want to mention that before I forgot it. With that, let's go to questions and see what's on your mind out there.
Wes, I'll let you know I'm going to do my share to eat that beef and pork.
My question is for Marty. The weakness in the basis in those far northeast counties, is that due to lack of data, or is all the data the same time frame around the state?
Yeah, so No, those are, from, Kansas State University. They put those maps together, but it should be the same. So this is as of the 6th of November. So I think they update that each week. So so you can see there, this is a deviation from normal. So just trying to capture, are we better than normal or worse than normal? And of course, even though the East is not quite as strong, the basis in the East is not quite as strong as it is in Central and West. It's still a little above average. But I guess your question is this up to date? It's up to date, I guess, through the end of last week.
Okay, I was just asking because Melvin had mentioned that there wasn't data for a few of the counties in the far northeast region there on basis, and I was trying to get some of that, and I didn't know where they were pulling all of their data from, if it was a similar source that Melvin was asking about or not. So.
Oh, okay, I see what you mean. Okay, yeah, I'm not sure about what all locations they've got up there.
Well, so you can see the little flags on the map, the little markers? That's the terminal locations, and you can see they're pretty thin up in that particular area. There's several counties there that don't have any. What this type of mapping does is it kind of interpolates between the market points that they do have. So it's shading that color based upon interpolating between those terminal markets. So you can see it's a little thinner up there than what we might like. And so I know Melvin's also looking for some specific information on where there might be demand centers. So he's looking for like feed mills and ethanol plants and any kind of manufacturing or whatever that might be using product that might temporarily cause hot points in prices at certain locations. So that's what he's after with that data, and it is really interesting what he's looking for, because that could be a real interesting marketing opportunity for our producers.
Yes, we're trying to get him the information, but it may be after harvest season.
Understood. Other questions out there?
Hey, John, this is Raisha. I know we talked a lot about China, but I was reading somewhere this morning that UMCA might be passing this week or coming up in the future weeks. How much was that factored into some of these numbers? Do you know?
So, hey, Seth, are you on the line? Do you have a comment on the FAPRI baseline and what is or is not included?
Well, so we did our small outlook here. I think that it is assuming, I mean, NAFTA and USMCA effects not so different. So it's assuming that we get someplace with that it doesn't fall apart. Again, I think the issue would be a negative if it didn't pass. I think there's just a general expectation in the market that that's not what's going to happen. That would be a very bad situation.
I was going to also ask, we have Dr. Seth Meyer, who is one of the co-directors of FAPRI, on the line. I was going to open this up for you, Seth, if you wanted to offer any additional comments on what we've talked about today.
Oh, no, I just want to say I really enjoyed myself. It's a big shift. I used to follow this stuff every day. You folks were very insightful. I thought that some of the charts about where we had gone on the weakness on the demand side were really fascinating, because as far as production goes, USDA is within 19 million bushels of where they were on corn production in June. Now, there was a little less carry in, because things tightened up, but I thought that was a really great slide to talk about. Demand weakness has been the real surprise. No, I have nothing to add because it was really good. I really enjoyed myself. Thank you.
Other questions? Okay, well, if no one has any other questions, I did want to extend an invitation to everyone that if you want to have a specific topic covered in the next session in December, please send me an email. My email is at the end of this slide set, which will be posted out there on AMAP, www.amap.missouri.edu. We also have, there's a YouTube channel and such that you can also see the slides on. But if you have questions, or you had a question from today's presentation and you'd like to ask that anonymously, you're certainly welcome to do that. Just send me a note, and we're happy to address a topic or a question, whatever things you'd like to see talked about. So we appreciate you attending today, and have a good afternoon.